So Nexus is a cross-border fund. We have an office in Menlo Park, we have an office here in Bangalore and one in Bombay, and we invest across two legs of the sort of investment market. One is cross-border technology, so where we are investing behind either Indian entrepreneurs that are looking to start companies here, take them global, mostly tech companies, and the second is even entrepreneurs in the US that are looking at global plays from the start, where India could be a significant part of their strategy and very early on, right? So that's one leg of our investment thesis. The other leg is investing behind domestic consumption. Okay. So that would be anything to do with retail, healthcare, education, all the large sectors in the India market. What are the three things that we look for? One is obviously always the team. The team is the most important thing. People that bring a certain passion, a certain sort of sales capability, a certain adaptability and so on. The second I would say is the market size. How large is the market that you're targeting? And the third is, are you really thinking of something that would differentiate you not just in the short term but on a long term basis? So thinking through how is it that in a market where in India in particular you see Me Too's emerge very quickly in a segment, how do you make sure that you stay ahead of the curve, right? So those I would say are the three main criteria. The fourth criteria, particularly as a VC, and I'm sure it applies for angels as well, is capital efficiency. So you're also looking at making sure that you're not spending $100 to get $10 in revenue. So I actually think that the problem that we are seeing is really related to more late stage companies. So Series C's and Series D's is where we have a big problem. Some of that has also come down to the lower level. Series B's are getting delayed and so on. But at the early stage, let's say seed investing or angel or even at Series A, the quality of entrepreneurs that you're seeing is the same, if not better than previous years. So from a standpoint of an investor, I would say that this is probably a good time to be investing, because people are a lot more circumspect about building their businesses. People are, we talked about capital efficiency. People are a lot more capital efficient or thinking about capital efficiency at this point. So in my view, I actually don't think that 2017 is going to be that bad as people make it out to be. There is going to be some pain in the system, because some companies that were seed funded are not going to be able to raise Series A. Some people that were Series A were not going to be able to raise Series B. But that's part and parcel of the VC ecosystem. So I think I laid out the four criteria when you're thinking about making an investment. I think that applies across the investing stage. So whether it's a seed or a Series A or a Series B, you're always looking to make sure that it's a great team and targeting a large market. So I don't think that so I would not. I started investing in '99. I saw 2001. I've seen 2008, 9. This will also pass, right? So there will be companies that will get created out of this. Make My Trip started in 2000, went through the tough times in 2001. Today has created tremendous value. 2008, Flipkart started. Snapdeal. All these guys started in 2008. They've all built large businesses. So I think you'll see companies emerge in 2017. We don't know which ones. Could be in healthcare, could be in supply chain, could be in financial services. There are many areas where there are very, very large markets, and there's a tremendous amount of disruption happening. So you look at things like financial services. There is a huge need around financial inclusion. India is bringing the whole India stack into this equation. So new entrepreneurs will emerge who will take that underlying sort of platform and build new companies around it, and will take away share from existing players, or even create new sort of markets which don't exist right now.